Congress is nearing the finish line for what is about to be the biggest federal benefit changes in over a decade. Do you know how these are going to impact you? In this video, I'm going to break down what's changing, when it's changing, and what you need to do to protect your federal retirement. Let's dive in. Hey guys, welcome to the channel. This is David Sedia. I'm a financial advisor who works alongside federal employees, helping them understand their benefits and making plans for retirement. In today's video, we're going to go over some of the congressional changes, which are also part of my article on Federal News Network. I'm going to go ahead and link that down here in the description. Make sure you check that out. Let's go ahead and get into the video. Now, the groundwork for these cuts is known as HCON Res 14, which is the House Concurrent Resolution 14, or the 2025 budget. And these changes are looking to cut around $50 billion from federal retirement benefits. Now, the changes that they've outlined have really been cut back, and now we're actually looking at roughly $15 billion in cuts. This bill has gone back and forth, and the House has gone ahead and voted on the reconciled version of this bill, and they were able to pass this on May 21st. This bill goes over to the Senate for them to vote on. If they can agree, then that will go ahead over to President Trump's desk to sign into law. Now, let's go ahead and dive into what's changing. And then what we'll do is we'll take a look at what isn't changing, because those are going to be some of the things on the horizon that might resurface in the future. So one of the biggest changes, and probably the most widely discussed change, is the FERS Supplement. The SRS, or Special Retirement Supplement, is going to be going away. And this is a change that has been debated on because a lot of people took the DRP or the VERA with the understanding that they were going to receive this benefit. Let's first explain why this was created to start with. So there are certain criteria that one might need to reach to be eligible for the supplement, and the supplement was essentially for those under 62 as a pat on the back from the government of saying, hey, thank you for your years of service. We're going to help you make it until you're able to now claim Social Security. So this would be a bridge of income from retirement until age 62, at which point the government says, hey, now you're able to take Social Security. Whether you do or don't is up to you, but we've helped you make it to this point. Now, what they're looking at doing is getting rid of this supplement, which is thousands, if not even $100,000+ that somebody could receive in benefit. The good news is, for anybody who took the DRP or VERA, that they have pushed back the implementation date for this. This was supposed to be when the bill was enacted, and they recently changed that to actually be January 1st, 2028. Now, the other thing that they changed is they are grandfathering in people who are already collecting. So I think we're going to see a lot of people. A very popular retirement date will be December 31st, 2027. Additionally, special groups such as law enforcement officers, firefighters, and also air traffic controllers are expected to continue receiving the supplement even after the January 2028 date. This, of course, is still potentially subject to change, as we don't have the final version of the bill out just yet. The next change, which doesn't affect everybody directly, but this will indirectly affect those of you who are still working for the federal government. And that is the change to have new hires either be at-will employees or to contribute more towards the pension system. So right now, a FERS employee who was hired after 2013 pays 4.4% into the pension system. Under this change, they would have the choice to either pay 9.4%, 5% more, or become a at-will employee. This means that they could be fired anytime, even if not for cause. That change is going to be permanent initially. So I think what we're going to see is most people are going to opt for the lower pay and that higher retirement contribution. Now, this is expected to be implemented at the bill's enactment date. So this should come out sometime here, probably in mid-2025. The reason that this might be so impactful to those of you current employees is with all the people who took the VERA, who took the DRP, who might be RIFT, that means that the government's going to really need to probably fill in some of these gaps, right? Some of these job positions might be found that they were indeed important and need to be refilled. Now, the next change didn't receive much opposition, and that was to change the Federal Employee Health Benefit Plan, FEHB, to audit essentially the plan. to make sure that the family members on the plan are indeed all still eligible to be enrolled. It means kids who are under 26, that once they turn 26, that they are off the plan and that is being registered, because the government pays 75% of this cost. So if there are people who are ineligible, that is extra tax dollars going to somebody who maybe shouldn't be receiving that. Finally, the last change on here is a $350 fee for the Merit Systems Protection Board, MSPB, which is to file for appeals. Now, the good news is if the appeal is accepted, they actually will refund the $350 filing fee. The intention here is to just cut back on those less serious appeals and to actually have some kind of monetary commitment so that only serious ones are being submitted. Now let's look at what's been shelved, because these things might come back. I mentioned earlier that the budget cuts were supposed to cut $50 billion from the budget over the next 10 years. And these cuts as they are only around $15 billion. So we might see some of these other things resurface here in the coming years, and we want to make sure that we can plan accordingly. Now, the next change is probably the most detrimental to somebody's retirement, and luckily they nixed this from the bill. And that would be to change or get rid of the cost of living adjustment to your pension. So there were talks about either reducing the inflationary adjustment or to potentially just altogether get rid of that adjustment. Now, this wouldn't be much of a surprise actually, because a private annuity actually charges a fee known as a rider, basically an add-on cost, in order to have an inflationary adjustment. As it stands, the FERS annuity doesn't have anything like that. You just automatically get it. And if we look at things like the survivor benefit on this annuity, you have to pay either 5 or 10% if you want to leave part of this to your spouse, right? It's an add-on, an extra cost. So this is something that could definitely resurface in the future, and it's something that should be very easy to plan and factor into some retirement planning tool to adjust and look at what if we had a reduced or no cost of living adjustment to our pension. Do you have enough money in TSP? Do you have enough Social Security to help support that? Now, here's how it works. The annuity gets a cost of living adjustment based upon what the CPI, the Consumer Price Index, increases by each year. If that CPI index increases under 2%, the federal employee will get whatever that index increased by. So if it was 1.5, you would be credited 1.5. If the CPI index increases between 2 to 3%, you will get credited 2%. It will round down. And then finally, if the CPI index increases at 3% or higher, then you will get the CPI index increase minus 1%. So as you can tell, in other words, if inflation is above 2%, your pension is going to lag inflation, right? It's not going to fully keep up. Now, the next change was just very recently nixed from this bill. That was going to be the change from the high 3 to high 5 salary calculation. Actually, on May 21st is when that was cut out of this bill. And that was in order to get the appropriate votes for them to get this reconciled bill passed through the House. Now, the current calculation of high 3 salary looks at your most recent 3 years of highest basic pay. That means that overtime, bonuses, hazard pay, those are not included in this calculation. Now, the other part here is a lot of people, I think, believe that this would be a lot more damaging than what it is. And it is definitely still something that would hurt somebody's retirement, but it is probably not to the degree that I think a lot of folks think. So let's go through an example. Let's look at somebody who earned a 100K salary in 2020. And let's look at the cost of living adjustments over the past 5 years and compare what a high 3 versus a high 5 salary would look like. So if we look through some of these numbers and we add this up, what we can see is that this would equate to be a 3.7% reduction to one's pension, right? Or annuity. Now, if there was a step increase or promotion, that might lead to this being higher than 3.7%. But the other part that I would mention is the past 5 years, these salary increases have been a little bit higher than the average 5 years, right? Typically, it's about 1% less than what we've seen over these past 5 years. The next change that actually had a lot of opposition was increasing the FERS contribution rate. So a new hire at the current time pays 4.4% into their pension, whereas somebody who was hired before 2013 under FERS, they're going to be paying 0.8%. If you were hired in 2013, or if you're in FERS RAE, then you're paying 3.1%. And then if you're in FERS FRAE, those hired after 2013, then you pay that 4.4%. What this change was going to do is it was going to just level this across the board. It's going to have everybody pay 4.4% into the system. Now, let's go through an example. Let's look at how impactful would this actually be. So if you had a 100K salary and that increased at, let's say, 2% a year, and let's also pretend that you just earned a 5% rate of return. In that case, for a 10-year period, you would pay $40,000 more into the FERS system. And had you been able to invest that money instead, you would have had another $10,000 from investment growth. Now, this is only just over 10 years. Imagine that you worked a full 30-year career with the government. That's like $150,000. And if we compare that to something like the change of getting rid of the FERS supplement, this change would have been equally as impactful as that. This next one affected, or would have affected, everybody. And that was to change the healthcare system, right? The healthcare, the FEHB, Federal Employee Health Benefit, is considered to be one of the best benefits that you guys get. And what they were looking at doing is changing it from a contribution or percentage contribution plan to instead a voucher system, where instead of the government paying roughly 72% towards your healthcare premiums, they would actually pay a fixed dollar amount that would be increased by general inflation. Now, it's important to mention, this isn't changing your coverage, right? This is just changing how much the government and how much you are paying of your premium. So this doesn't mean you're losing coverage or getting less coverage. Now, what do we take away from this, right? Now, the takeaway is, if they were to change the healthcare system in the future, that might make Medicare Part B more viable. Now, what that means is, for anybody who's still working or maybe hasn't made or had to make that Medicare Part B decision yet, that might be something to consider. What if they do, in the future, change this healthcare system? What if this comes back? Because this was going to save the government $20 billion over the next 10 years. That was going to be a significant portion of the cuts. In fact, this change alone would have been more savings for the government over the next 10 years than all of the current changes still in the bill. Now, the last one didn't catch a lot of attention, but it was the G-Fund reform. And what they were looking at doing is having the G-Fund mirror short-term treasuries. The G-Fund has often been looked at as a place of stability, a place to park money when things look more volatile in the stock market or the economy. And by doing so, this would expose the G-Fund to more volatility, and also open up the possibility here that there could, well, rare, be a negative year. So the question is, what should you do now? Well, number one, you want to monitor legislation. This isn't the final version just yet, so you want to make sure that you stay up to date in case there are any last minute changes. Number two, you want to run retirement scenarios. You want to incorporate some of the changes that are coming in this bill, but also some of those that were not passed but could resurface in the future. And you want to account for these and make sure that you have some extra wiggle room. Number three, you want to review your investment strategy. Are you invested correctly, especially if you were to retire earlier than maybe you originally planned? Number four, you want to review your Medicare Part B decision. If you haven't reached the age at which you need to make this decision yet, this is especially pointed to you, as that is a future decision. And now knowing that they could potentially switch to a voucher system in the future, that's something that you're going to want to account for in your retirement plan. Number five, talk to your benefits officer, human resources, OPM, a financial advisor, someone that can help you plan for these changes and potentially some of these other ones that might come back in the future. Final thoughts, federal benefits are no longer safe. You need to make sure that you're accounting for all these things and that you don't assume that what you believe to be your benefits right now will 100% be those benefits in the future. With that said, proactive planning isn't just smart here, it's essential. You want to make sure that you have a plan, you've accounted for some of these changes, and that you give yourself extra wiggle room and cushion just in case anything else changes here in the future. Thanks for watching. I hope you found this video very helpful. Please share this video with your colleagues and subscribe for more videos in the future. Hope to see you soon.